Would you pay over $1,000 per month for a car? What if I told you that millions of Americans already are, and the situation is only getting worse? Car prices have skyrocketed, interest rates are through the roof, and even used cars are no longer a bargain. The market is in chaos, leaving buyers with impossible choices. How did we get here? What's driving these insane prices? And most importantly, when will it end? The Edmunds report that changed everything. Just when you thought car prices could not get any worse, a shocking new report from Edmunds has shattered expectations and exposed a crisis that no one can ignore. The findings reveal an affordability crisis that has reached historic levels, leaving millions of consumers unable to afford a vehicle. The numbers are staggering, with over 73% of Americans now considering car ownership completely out of reach. This is not just about high prices, it is about the fundamental way the car market is shifting and how buyers and sellers alike are struggling to keep up. Edmunds' latest data highlights an unsettling reality. Car affordability has plummeted while vehicle prices have skyrocketed. The financial strain has left consumers questioning whether they will ever be able to purchase a vehicle again. This report serves as a wake-up call, forcing both industry leaders and everyday buyers to confront an uncomfortable truth. The car market is no longer functioning the way it once did. And the worst part, it is only getting harder for the average person to afford a car. The affordability crisis. How did we get here? In just a few years, the cost of a new vehicle has risen by over 30%, leaving many wondering, how did this happen? The answer is not simple, but a combination of economic pressures and industry decisions has led to the crisis we see today. One of the biggest drivers of rising car prices has been supply chain disruptions, many of which stem from the global shutdowns that occurred in the early part of the previous decade. These disruptions affected everything from semiconductor production to raw material availability, limiting automakers' ability to produce cars at the scale needed to meet demand. As a result, the supply of new vehicles dwindled, pushing prices even higher. At the same time, inflation has played a crucial role in making vehicles more expensive. Rising material costs, increased labor expenses, and higher transportation fees have all contributed to the ballooning price tags seen on dealership lots today. Automakers, in an effort to maintain profits, have focused on producing high-margin luxury models, leaving fewer options for consumers looking for affordable new vehicles. The outcome is a market where basic transportation has become a financial burden for most households, forcing many to either delay their purchase or look for alternatives. The rising costs of car ownership are outpacing income growth, making it more difficult than ever for consumers to justify the purchase of a new vehicle. For years, buyers could expect moderate increases in prices, but nothing compares to the steep hike seen over the past few years. If the trend continues, the dream of car ownership could become unattainable for the average American household. The monthly payment trap. How interest rates are squeezing buyers. Would you pay $1,000 a month for a car? If that number sounds absurd, consider this. Millions of Americans already are. Car loan payments have reached record highs, with the average monthly cost now exceeding $700 and a growing percentage of buyers paying well over $1,000 every month. These payments are being driven by a combination of high vehicle prices and rising interest rates, making car financing more unaffordable than ever. Interest rates for auto loans have doubled since the early part of the decade, making financing a vehicle far more expensive than it was just a few years ago. This increase means that even if a buyer can negotiate a reasonable price on a car, they are still at risk of paying thousands more over the life of their loan due to interest costs. The Federal Reserve's decision to raise interest rates in an effort to curb inflation has had a significant impact on the auto market, leaving many buyers struggling to afford even the most basic vehicles. To offset these rising costs, many consumers have opted for longer loan terms, stretching their payments over 6, 7, or even 8 years. While this might make the monthly payment more manageable, it also means buyers are stuck in debt for much longer, often paying far more for their vehicle than it is actually worth. This is a dangerous financial trap, locking people into car loans that may become unsustainable if economic conditions shift. The growing reliance on long-term loans is creating a ripple effect throughout the industry, making it harder for buyers to trade in their vehicles when they need an upgrade. Negative equity, owing more on a car than it is worth, is becoming increasingly common, leaving many people unable to escape the financial burden of their current vehicle. With interest rates expected to remain high for the foreseeable future, the auto loan crisis is only set to deepen. The price disparity between expectation and reality. Most car buyers set their budget with a specific number in mind. The problem, that number no longer aligns with reality. A recent survey found that most consumers are hoping to spend around $30,000 on a new car, yet the actual average price for a new vehicle has soared to over $47,000. The gap between expectation and reality has never been greater, and for many, the only solution is to lower their expectations or exit the market altogether. The biggest issue driving this disparity is the near extinction of affordable new cars. A decade ago, consumers had a variety of options for under $20,000. Today, those choices have all but disappeared. Automakers have shifted their focus towards producing larger, more expensive vehicles, including high-end sport utility vehicles and trucks that come with luxury price tags. The few remaining affordable options are often stripped-down base models with minimal features, leaving consumers with little choice but to either pay more or settle for less. Meanwhile, automakers continue to prioritize profitability over accessibility. High-margin models dominate dealership lots, while budget-friendly vehicles remain in short supply. For buyers, this means making tough decisions, either stretching their budgets to accommodate rising costs or holding off on purchasing altogether. The impact of this shift is already being felt, as many would-be buyers are being pushed out of the market entirely. This reality is creating a major challenge for the industry. If car ownership continues to become an unattainable goal for a growing number of consumers, demand will inevitably decline, forcing automakers to reconsider their pricing strategies. Until that happens, however, buyers will have to navigate an increasingly difficult market where affordability is more of a hope than a guarantee. The car market is in a state of transformation, and the latest data from Edmunds confirms what many already suspected. Owning a car is no longer a simple or affordable process. As prices continue to rise, interest rates climb higher, and inventory remains constrained, consumers are left wondering whether they will ever be able to purchase a vehicle again. The situation is dire, and unless major changes are made, the future of car ownership may never look the same again. Why used cars are no longer the affordable alternative, and for years, used cars were the go-to solution for budget-conscious buyers looking for a deal, but those days are over. The price of a used vehicle has soared to an average of $26,995, a significant increase from pre-pandemic levels. What was once a viable alternative to expensive new cars is now nearly as unaffordable. Several factors have contributed to this shift. The shortage of new cars over the past few years drove more buyers into the used market, spiking demand. At the same time, consumers have been holding on to their vehicles longer, limiting the supply of trade-ins that dealers rely on to restock used inventory. With fewer cars circulating, dealers have been able to keep prices high, leaving many buyers without realistic options. Used car affordability is rapidly eroding, and the buyers who once depended on this market for cost savings are now being pushed out. Those who cannot afford new cars are finding themselves with fewer alternatives, making reliable transportation an increasing challenge for many households. The negative equity time bomb, buyers stuck in debt. A growing number of car owners are trapped in a financial nightmare. 20% of all vehicle owners currently owe more on their car loans than their cars are worth, with some buyers facing negative equity of more than $10,000. This crisis stems from long-term auto loans exceeding 72 months, often extending up to 84 months or more. Many of these loans were taken out during the past few years when car prices were at record highs, leading buyers to overpay for vehicles that have since depreciated rapidly. Lenders, eager to profit from the demand surge, approved auto loans with inflated vehicle values, assuming market conditions would remain stable. But as supply chain issues eased and new car production resumed, used vehicle values began to decline, trapping buyers in financial agreements that no longer align with market reality. The consequence? Many consumers cannot trade in their vehicles for something more affordable, nor can they refinance their loans to reduce payments. With no viable exit, they remain stuck in debt, forced to keep cars they can barely afford while continuing to make payments on loans that exceed their vehicle's actual worth. The repossession wave. How many people are losing their cars? The car market is not just unaffordable, it is also unstable. Auto loan delinquencies are now at their highest level since 2008, signaling a growing wave of repossessions. As more borrowers struggle to keep up with rising monthly payments, lenders are tightening restrictions, making it even harder to secure financing. Many consumers who finance vehicles in the past few years did so under historically low interest rates. However, as rates have climbed, monthly car payments have become unaffordable for an increasing number of buyers. The result? Lenders are reclaiming vehicles at an accelerating pace, leaving thousands of consumers without transportation. Tightening of auto loan approvals means that buyers with lower credit scores are being pushed out of the market entirely. Without access to financing, they are left with limited choices, often resorting to unreliable older vehicles or alternative transportation methods. This trend is expected to continue as more consumers default on their loans, further exacerbating financial instability in the auto market. Why car prices aren't dropping despite high inventory. With dealerships struggling to move inventory, many buyers expected prices to drop significantly. However, that has not happened. Inventory levels have increased, yet prices remain stubbornly high. The reason? Dealers and manufacturers are actively working to keep them that way. Many dealerships purchase vehicles at high costs and finance their inventory with expensive loans. Lowering prices too quickly would mean taking massive losses, so they are holding onto inventory, hoping to sell at higher prices instead of offering discounts. Additionally, automakers are limiting production to prevent oversupply, ensuring that demand remains high enough to justify premium pricing. Unlike past market cycles where oversupply led to price drops, manufacturers now have more control over production levels, allowing them to keep prices elevated. This strategic limitation of supply is slowing down the market correction, leaving buyers frustrated and delaying affordability improvements. While consumers wait for relief, many are instead opting to delay purchases, further complicating the market. Until manufacturers and dealers adjust pricing strategies, buyers will continue to face steep costs, regardless of whether they are shopping for new or used vehicles. Buyers are holding onto their cars longer than ever. If you think used cars are expensive now, just wait. People are keeping their vehicles longer than ever before. The average age of a car on American roads has now surpassed 12 years, a record-breaking figure that speaks volumes about the state of the auto market. With the cost of both new and used cars skyrocketing, many consumers are left with no choice but to extend the lifespan of their current vehicles. This trend is not just about affordability, it is about survival. Instead of trading in their cars for newer models, drivers are investing in repairs and maintenance to keep their aging vehicles running. This has led to a surge in demand for auto parts and mechanic services, causing prices for repairs to rise as well. Brake replacements, engine repairs, and transmission work that once seemed like a burden are now seen as the more economical choice when compared to the price tag of purchasing another vehicle. Beyond repair costs, there is another consequence of keeping older cars on the road. Insurance premiums can sometimes increase for aging vehicles due to safety concerns and higher chances of mechanical failure. Additionally, fuel efficiency may decline as older engines wear out, leading to increased costs at the pump. For automakers, this is a warning sign. If consumers are unwilling or unable to purchase new vehicles, manufacturers may have to rethink their pricing strategies and the types of cars they produce. This shift in consumer behavior could permanently alter the auto industry, forcing car companies to reconsider their approach to affordability. The rise of car sharing and alternative transportation. If you cannot afford a car, why not just borrow one? That is the question more consumers are asking as they explore alternatives to traditional car ownership. Services like Turo and Zipcar are gaining traction, offering an option that eliminates the financial burden of car loans, insurance, and maintenance. Rather than committing to an expensive purchase, users can simply rent a vehicle when they need it, making it a cost-effective solution for many urban dwellers. Ride-sharing apps such as Uber and Lyft are also seeing increased demand as people reevaluate whether owning a car is worth the expense. In some cities, the total cost of ride-sharing, public transportation, and short-term rentals is now more affordable than car ownership, especially when factoring in fuel, insurance, and financing costs. Public transportation systems, which saw a decline in usage during recent years, are experiencing a resurgence as commuters look for ways to cut expenses. Bicycle sales and e-scooter rentals are also on the rise, particularly in urban areas where traffic congestion and parking costs make owning a vehicle less practical. This shift away from car ownership presents a direct challenge to the auto industry. If more consumers embrace alternative transportation, the demand for new vehicles could decline significantly. This could accelerate the need for automakers to pivot towards different business models, such as mobility as a service, subscriptions, or more affordable leasing options. For many buyers, the traditional model of car ownership is becoming less attractive. The industry must respond accordingly or risk losing a significant portion of its customer base. Automakers are in trouble, declining sales and profit warnings. If you think only buyers are struggling, think again. Car makers are in deep trouble too. For years, automakers focused on producing high-end vehicles with premium price tags, betting that demand for luxury features and advanced technology would keep profits soaring. However, as consumer budgets tighten, those expensive models are sitting unsold on dealership lots. Major automakers such as Ford and Nissan are already feeling the impact, reporting sharp declines in profit margins. Companies that once thrived on high-margin sales are now realizing that fewer consumers can afford their vehicles. This imbalance has led to production slowdowns, layoffs, and inventory challenges as manufacturers struggle to find buyers willing to pay top dollar for new models. At the same time, dealerships are finding themselves in a difficult position. Many are holding onto vehicles rather than slashing prices, hoping that market conditions will improve. However, with interest rates climbing and affordability concerns growing, fewer customers are willing to take on the financial burden of a new vehicle. The current situation raises an important question. Will automakers finally adjust their pricing strategies? Some manufacturers are beginning to acknowledge that they must offer more budget-friendly options if they want to attract buyers. However, without significant industry-wide changes, the problem is likely to persist, leaving both buyers and sellers frustrated. The future of car buying, where do we go from here? Is the traditional car ownership model dying? The rapid changes in the market suggest that a major transformation is already underway. Consumers are searching for more flexible and affordable ways to access transportation, and car manufacturers are being forced to adapt. One of the fastest growing trends is car subscriptions. Instead of purchasing a vehicle outright or signing a long-term lease, subscribers pay a monthly fee that covers the cost of the car, maintenance, and insurance. This model is gaining popularity among younger consumers who prioritize flexibility and do not want to be locked into a multi-year commitment. Leasing is also becoming a more attractive option as it allows consumers to drive a newer vehicle without the financial strain of a traditional auto loan. Some automakers are even experimenting with shorter-term lease agreements and more competitive financing options to attract hesitant buyers. Meanwhile, a few manufacturers are beginning to recognize the need for lower-cost vehicles. In response to consumer demand, some companies are reviving smaller, more affordable models that had previously been discontinued. These efforts could signal the beginning of a shift back toward accessible car ownership. Ultimately, the future of the automotive industry will depend on how well it responds to these changing consumer behaviors. Buyers have made it clear that they are no longer willing to accept sky-high prices and long-term financial strain just to own a car. Whether through alternative transportation, new financing models, or lower-priced vehicles, the industry must evolve to meet the needs of a new generation of consumers. As the market continues to shift, one thing is certain: car buying will never be the same again. Government policies and their impact on car prices. Car ownership has never been more expensive, and now government policies are stepping in to address the crisis, or potentially make it worse. Federal and state regulations are playing a significant role in shaping the future of vehicle affordability, from emission standards to tax incentives for car buyers. But are these policies actually helping the average consumer? One of the biggest factors influencing car prices is government-mandated emission standards. Automakers are under increasing pressure to produce more fuel-efficient and electric models, which often come at a higher cost due to advanced technology and limited infrastructure. While these regulations aim to reduce environmental impact, they also push manufacturers to focus on premium, high-margin models instead of affordable vehicles. Additionally, lawmakers are exploring tax incentives to make vehicle ownership more accessible. Some proposals include tax breaks for first-time car buyers or subsidies for those purchasing fuel-efficient models. However, these policies often favor higher-income buyers who can already afford a new car, leaving lower-income consumers struggling to find budget-friendly options. Government intervention in the car market can be a double-edged sword. While policies may encourage automakers to innovate and offer incentives to buyers, they can also drive up costs and limit the availability of lower-priced vehicles. The future of affordability largely depends on how lawmakers balance regulation with consumer needs. The push for electric vehicles, will it help or hurt affordability? Electric cars are supposed to be the future, but will they actually be affordable? The global push toward electric vehicles is reshaping the automotive landscape, but one major concern remains: cost. Electric cars are often touted as the next big thing in transportation, but their high production costs and limited charging infrastructure present challenges for widespread adoption. But the Biden administration has heavily invested in promoting electric vehicles, aiming to make them more accessible through tax incentives and infrastructure expansion. Yet, despite despite these efforts, the price of electric cars remains significantly higher than traditional gas-powered vehicles. Battery production, a key component of electric vehicle costs, continues to be expensive, and supply chain constraints further complicate the issue. For many buyers, affordability is the biggest hurdle. While tax credits help offset some of the upfront costs, they do not lower the base price of electric vehicles. Consumers who cannot afford a new gasoline-powered car are even less likely to afford an electric model, creating a growing divide in car ownership. Charging infrastructure also plays a crucial role. In areas with limited charging stations, electric vehicles are not a practical option, forcing buyers to stick with traditional cars despite rising fuel prices. Until electric vehicles become more affordable and convenient to own, they will remain out of reach for many consumers. The role of big banks and lenders in the crisis. Are banks making car buying even harder? Beyond rising vehicle prices, financing has become another major obstacle for car buyers. Interest rates on auto loans have surged in recent years, making monthly payments more expensive and locking consumers into long-term debt. Banks and lenders have tightened their lending requirements, making it harder for consumers with lower credit scores to secure financing. As a result, many potential buyers are being pushed out of the market entirely, unable to meet the strict criteria for a car loan. Additionally, the trend of longer loan terms, sometimes stretching as long as 84 months, has become more common. While this may lower monthly payments, it significantly increases the total amount paid over time, leaving consumers in financial strain for years. Buyers who take on these extended loans often find themselves in negative equity situations, where they owe more on the car than it is worth. The rising cost of financing is forcing many consumers to rethink their purchasing decisions. Some are turning to leasing, while others are delaying car ownership altogether. Without significant changes in lending practices or interest rate reductions, vehicle affordability will continue to be a challenge for millions of buyers. Where does the car market go from here? Will car prices ever return to normal, or is this the new reality? With all these factors at play, the question remains, what does the future hold for the car market? While there are no definitive answers, industry experts predict a mix of challenges and opportunities. One possibility is that automakers will begin reintroducing budget-friendly models to attract more buyers. Some manufacturers are already exploring ways to cut production costs and offer more affordable options without sacrificing quality. However, these models may still take years to reach the market, leaving current buyers struggling in the meantime. Another shift may come in the form of alternative ownership models. Car subscriptions and flexible leasing programs are gaining popularity, providing consumers with access to vehicles without the long-term financial commitment of buying. These models offer a middle ground between traditional ownership and ride-sharing, appealing to those who want a car without the burden of a large upfront payment or high monthly loan installments. The future of the car market remains uncertain, but one thing is clear: affordability is now a central issue that both consumers and the industry must address. Whether through policy changes, financial innovations, or new production strategies, the coming years will determine whether car ownership remains an attainable goal or becomes a luxury for the few. But what do you think the future will be like? Let's talk about it in the comments. Thanks for watching.